The Sri Lankan economy has continued to show signs of stability, with the CCPI inflation coming in at 12% for June amid a high statistical base effect and continued deceleration of global commodity prices. With inflation easing, we've seen the Central Bank of Sri Lanka reduce monetary policy by 450 basis points since June, which has translated into lower deposit rates and GSEC yields, although AWPLR, which was at 17.7% last week, has been relatively slow to respond. However, we expect lending rates to continue to normalize in the upcoming weeks and months. In terms of exchange rates, we've seen the rupee come under a bit of pressure over the last couple of weeks. This is largely on the back of the recent announcement of relaxation of capital and import controls, as well as increased dollar demand from the Sri Lankan banking system following the announcement of the DDO and the exposure to SLDBs, which needs to be covered. In terms of the dollar generation, we've tracked quite well in the first half, with considerable reduction in trade deficits and improvement witnessed in tourism inflows as well as worker remittances. In terms of tourist arrivals, we are close to about 1 million in year to date, and we believe by the winter season we'll be close to pre-pandemic levels, which should support the rupee to some extent. However, with interest rates reductions, we believe that we will witness a gradual improvement in both consumption as well as import demand, which would put further downward pressure on the rupee in the second half of this year. In terms of new development, we witnessed the Central Bank Act being passed in the Parliament, the DDO parameters being announced, and significant progress being made on the external debt restructure front. All three of which are important preconditions for the first review with the IMF slated for September. So we believe that we are tracking quite well in terms of meeting the requirements of the first review. And in terms of the financial markets, we've seen both the equity market as well as the fixed income market rallying following the announcement of the DDO parameters. We've seen the equity market do about 17% in July, and it's up about 30% for the year so far. And even on the fixed income end, we've seen the treasury bond yields reducing roughly about 5 to 10% in the mid to long tenor, and treasury bill yields correcting sharply as well, with almost about 15% drop since the beginning of the year, with the DDO allied risk premia now being eliminated. So we believe that even moving forward, following a successful completion of the first review of the IMF program, we may attract more foreign fund flows to the local financial markets, with there being further room for interest rates to adjust downwards, as well as from the equity point of view. We believe that there will be a gradual improvement in corporate earnings going forward, as well as the market still being fairly undervalued in comparison to its historical earnings base, as well as the regional peers.